Hello guys, thank you for watching my channel. Again, welcome to my channel for watching this video. My today's lesson is the definition of insurance. This is very simple that I cannot discuss in a single lessons uh, all about definition of insurance. If I want to discuss insurance elaborately, then I have minimum need 5 to 6 class and minimum 3 to 4 hours to understand you about insurance. Within short period, I couldn't explain you properly, but don't worry. I have collected so many notes points so that I can easily taught you what is insurance. I have collected the points from so many options, so many notes, so many books. So don't worry about it. I have collected many notes about insurance. I think after you watching this video, you don't have any query about insurance. You will be able to understand about insurance uh, and deeply understood such how many types of insurance, from whom the definition has come, and how types of insurance, where you will get such options to do insurance. First of all, you are showing my presentation on dashboard here. Someone please response if you are hearing, then I can forward it. Okay, you are showing in my dashboard. Here is written insurance. Okay, I am doing bold it so that you can understand easily. Okay, here you are watching insurance. My next topic is jump to navigation, jump to search. You have to, if you want to learn something, you have to jump to navigation and you have to search on Google, YouTube. You have to find by your own self. If you don't have interested, you can't never learn something what is very essential to you. Okay, you are showing there is a diagram in my presentation dashboard. Okay, there is a reason behind it why I have put it on here. Okay, I'll talk it later about that why I have. Sorry for interrupt. Again, I am starting from here. You are watching an advertising poster of a Dutch insurance company. It's a poster of Dutch insurance company. The duration was 1900 to 1918. Depicting an armored knight, financial market participants, credit unions, insurance companies, investment banks, investment funds, pension fund, prime brokers, trusts, finance, financial market, participant, corporate finance, personal finance, and public finance. You have watched that there are so many financial market participants. They have they are participants in financial market. we have to research, we have to study about that for briefly, deeply understood about insurance. First, you show that credit unions, the portion credit unions is at the top portion. Then you have watched insurance companies, investment banks. You have to uh, briefly discuss about investment banks, and you need to investment funds, pension funds, prime brokers, trust finance, etc. And here you also showing under that above that banks and banking. Banks and banking. If you want to learn about financial, you must learn about financial regulation, banks and banking, fund governance, stock market. From everywhere you have to raise your fund. Where you have got, no matter, you need to raise your fund. So for raising fund, can watch you can watch such types of videos, or you gather some information for bank and banking. Insurance is a means of protection from financial loss, in which, first of all, I'm talking about the definition of insurance. You must know about insurance. Insurance is a means of protection from financial loss, in which exchange for fee, a party agrees to guarantee another party compensation in the event of certain loss, damage, or injury. It is a form of risk management. Actually, the insurance is a form of risk management, preliminary used to hedge against the risk of contingent or certain loss. An entity which provides insurance is known as an insurer. Anyone can provide insurance. It may a man, it may a company, it may a organizations. Anyone can do insurance. Who do insurance? We call him insurer. Insurance company, insurance carrier, or underwriter. It's no matter. Anyone can do it. A person or entity who buys insurance is a person. Is known as policyholder. The person or the organization or the entity who buys insurance. That means the people or the company who buys insurance is known as policyholder. We can tell him policyholder. Okay, next. Why a person or entity covered under the policy is called an insured. Whenever a person or an entity covered under the policy, that means someone who has maintained the policy, is called insured. Policyholder and insured are often used as but are not necessarily synonyms, as coverage can sometimes extend to additional insureds who did not buy the insurance. The insurance transactions involve the policyholder assuming as guaranteed known and relatively small loss in form of a payment to the insurer in exchange for the insurer promise to compensate the insured in the event of covered loss. The loss or may not be financial, but it must be reducible to financial terms. Furthermore, it is usually involves some things in which insured has a insurable interest, established by ownership, possessions, or pre-existing relationship. The insured receives a contract called the insurance policy, which details the conditions and the circumstances under which the insurer will compensate the insured or their designated beneficiary or assign. The amount of money charged by the insurer to the policyholder for the coverage set forth the insurance policy is called the premium. That means we have understood the amount of money charged by the insurer or to the policyholder is coverage set forth insurance policy is called the premium insurance holder. It can be anyone can be holder the premium insurance. It's no problem. Then, if the insurance experiences a loss which is potentially covered by the insurance policy, the insured submits a claim to the insurer of processing by a claims adjuster. A mandatory out-of-pocket expense required by an insurance policy before an insurer will pay a claim is called deductible, or required by a healthy insurance policy co-payment. The insurer may hedge its own risk by taking out insurance, whereby another insurance company agrees to carry some of the risk easily, especially if the primary insurer deems the risks too large for it carry. Here is early methods which have been edited, and you are watching a poster in my dashboard. Okay, so merchants have sought methods. Merchants have there are sought methods to optimize risk since early times. Pictures, governments of the wine merchants, guided by Ferdinand Humboldt. Methods of transferring or distributing risk were practiced by Babylonian, Chinese, and Indian traders as long ago as the 3rd and 2nd millennia BC, respectively. Chinese merchants traveling treasures, river rapids would reassemble their wire across many vessels to limit the loss due to any single vessel capsizing. I think you are clear about methods of transferring disturbing. Risks were participated by Babylonian, Chinese, and Indian traders as long ago as the 3rd and 2nd millennia BC, respectively. Chinese merchants traveling treasures, river rapids could redistribute their wares across many vessels. Codex Hammurabi Law 238 C 1755 to 1750 BC stipulated that a sea captain, ship manager, or ship collector that saved a ship from total loss was only required to pay one half the value of the ship to the ship owner. In the Digesta Seu Benedict, the second volume of the Codification of Laws ordered by Justina, a legal opinion written by the Roman jurist Phalas in 235 AD was included about the Lex Rhodium law. It articulates the general average principle of marine insurance established on the island of Rhodes in approximately 1000 to 800 BC. Possibly by the Phoenicians during the proposed Dorian invasion and emergence of the supported sea peoples during the Greek dark ages. The law of general average is the fundamental principle that underlines all the insurance. In 1816, the archaeological excavation in Minya production a Narva Antonic dynasty era tablet from the ruins of the template of Antonius in Antinopolis, Egyptus. The tablet prescribed the rules and membership dues of a burial society collegium established in Lenivium, Italia, approximately 133 AD during the regime of Hadrian of Roman Empire. In 1851 AD, future U.S. Supreme Court Associated Justice Joseph P. Bradley once employed as an actuary for the Mutual Benefit Life Insurance Company, submitted an article the Journal of the Institute of Actuaries. His article detailed an historical account of sovereign density era life table compiled by the Roman jurist Alpian in approximately 220 AD that was also included in the digesta. Concepts of insurance has been also found in 3rd century. Concepts of insurance has been also found in 3rd century BC. Hindu scriptures such as Dharmastra, MS Dharmastra, Arthashastra, and Manastromi. The ancient Greeks and marine loans money was advanced on a ship or cargo to be repaid with a large interest in the voyage prospers. However, the money would not be repaid all if the ship were lost, thus making the rate of interest high enough to pay for not only for the use of the capital but also for the risk of losing it, fully described by Demosthenes. Loans of this character have ever since been common in maritime lands under the name of bottomry and respondentia bonds. The direct insurance of sea risk for a premium paid independently of loans began in Belgium about 1300 AD. Separate insurance contracts. Insurance policies not bundled with loans or other kinds of contracts were invented in Geneva in 14th century, as were insurance pools backed by pledges of landed estates. The first known insurance contract dates from June 1347. In the next century, maritime insurance developed widely and premiums were buried with risk. These new insurance contracts allowed insurance to be separated from investment and separation of rules that first proved useful many whatever. Then the earliest known policy of life insurance was made in the Royal Exchange London on the 18th June of 1583 for 383 pound. We all are don't know that and the earliest policy, that means the first policy of insurance has been made in Royal Exchange. In the Royal Exchange, it was made. Date was the 18th June 1583. That means to 500 years ago, at approximately. For 12 months on the life of Williams Gibbons, modern method, insurance became far more sophisticated in Enlightenment era Europe or specialized variety development. Okay, you are watching these posters about when it was happened, 1583. That means 500 years ago. The place was the Lloyd's Coffee House was the first organized market for marine insurance. Property insurance, as we know it today, can be traced to the Great Fire of London, which in 1966 devoured more than 13,000 houses. The devastating effects of the fire converted the development of insurance from a matter of convenience into the one of urgency. John's opinion reflected in Sir Christopher Wren's inclusion of a site for the insurance office in his new plan for London in 1667. A number of attempt fire a number of attempt fire insurance schemes came to nothing, but 1681 economist Nicholas Barbot and even Sears established the first insurance company, the insurance office for houses, at the back of Royal Exchange to insurance brick and frame homes. Initially, 5,000 homes are insured by his insurance office. At the same time, the first insurance schemes for the underwriting of business venture became available by the end of 17th century. London's growth as a center for trade was increasing due to the demand for marine insurance. In the latest 16th-18th, Edward Lloyd opened a coffee house, which became the meeting place for parties in the shipping industry, which could insure cargoes and ships, including those willing to underwrite such ventures. This informal beginnings led to establishment of the insurance market, Lloyd's of London, and several related shipping and insurance business. The dawn of hope suffered the Liberal government in their policy of social reform. Leaflet promoting the National Insurance Act 1911. Life insurance policies. Policies were taken out in the early 18th century. The first company to offer life insurance was the Amicable Society for a Perpetual Assurance Office, founded in London in 1706 by William Talbot and Sir Thomas Allen. Upon the same principle, Edward Reymers established the Society for Equitable Assurance on Lives and Sir Lee Worship in 1762. It was the world's first mutual insurer, and its pioneer age-based premiums based or mortality rate, laying the framework for the scientific insurance practice and development and the basis of modern life assurance upon which all life insurance schemes were subsequently based. In the late 19th century, accident for the first international insurance rules was the York and Trade rules for the distribution of cost between ship and cargo in the event of general averages in 1873. The associations for the perform and codifications of the law of nations, the founder of the International Law Associations was founded In Brussels, it published the first year in 1890. Before switching to the present title of the International Law Associations, by the late 19th century, governments began to initiate national insurance programs against sickness and old age. Germany built on traditional of welfare programs in Prussia and Saxony that began as early in the 1840s. In the 1880s, Chancellor Otto von Bismarck introduced pensions, old age pensions, accident insurance, and medical care that formed the basis for Germany's welfare state. The Britain more extensive legislation was introduced by the Liberal government in the 1911 National Insurance Act. This gave the British working classes the first contributory system of insurance against the illness and unemployment. This system was greatly expanded after the Second World War, under the influence of the Beveridge Report, to form the first modern welfare state. In 2008, the International Network of Insurance Associations, in general it's just INIA, then an informal network, became active, and it has been succeeded by the Global Federation of Insurance Associations, which was formally founded in 2012 to aim to increase insurance industry effectiveness in providing the input to international regulatory bodies and to contribute more effectively to the international dialogues on internet issues of common interest. It consists of its member associations and one observer associations in 67 countries, which companies account for around 89% of total insurance premiums worldwide. Insurance involves pooling funds from many insured entities known as experts to pay for the losses that only some insured may incur. The insured entities are therefore protected from risk for a fee, with the fee being dependent upon the frequency and severity of the event occurring. In order to be an insurable risk, the risk insured against must meet certain characteristics. Insurance as a financial intermediary is a commercial enterprise and a major part of the financial services industry, but individual enterprises can also sell insuring through saving money for future losses. Large number of similar exposure units, since insurance operators through pooling resources, the majority of insurance policies cover individual members of large classes, allowing insurance to benefit from the law of large numbers in which predicted losses are similar to the actual losses. Exceptions include Lloyd's of London, which is famous for ensuring the life of health of actors, sports figures, and other famous individuals. However, all exposures will have particular difference which may lead to different premium rates. Definite loss. These types of loss takes place at a known time and place from a known cause. The chassis classic example involves the death of insured persons on a life insurance policy. Fire, automobile accidents, and work injuries may all meet this criteria. Other types of losses may only be definite in theory. Occupational disease for conditions are no specific time, place, or causes in the time, place, and cause of loss should be clear enough that a reasonable person could objectively verify all the three elements. Accident loss, the event constitutes the trigger of a claim, should be for fortuitous or at least outside the control of beneficiary, the insurance, the only opportunity for cost. The size of the loss must be meaningful. And finally, I am again thanks to all for watching my videos. I hope you have understood very clearly about the insurance which I discussed in the videos. I think it has clear to you about insurance. You don't have any query. Okay.